In this video, I want to walk you through the solution to the first knowledge check of week 2, the 5 questions we did on revenue recognition. In this knowledge check, we were looking at transactions related to a bookstore, coffee shop bookstore. And in the first one, Perry's, the bookstore, sells children's books to a local elementary school during September on account for $850. So they collect the cash in October. Again, under the accrual basis, we recognize revenue when it's earned, not when the cash is collected. So the sale took place, the books were delivered in September. So the correct answer there is B, all the revenue recognized in September, nothing in October or November. Now, if you were doing this on a cash basis, of course, the answer would be C, and you'd recognize revenue when the cash was received, but that's not what we do with accrual basis accounting. So the correct answer is B. Next, Barry receives $100 in September from a customer to reserve 2 copies of a book that's not due out until October. So this is an advance payment, like a down payment or a deposit from a customer. We get cash, so cash goes up. We can't recognize revenue yet because we haven't earned it. We haven't delivered the product or service. That'll happen in October. So this is actually a liability to Perry's. So cash will go up 100 and a liability will go up for 100. Seems a little odd, called a liability, but not all liabilities are payable in cash. So Perry's has an obligation to complete the sale to the customer in October. That's a liability of $100. And then in October, when the books are delivered, the liability will be reduced and that $100 will be moved over and recognized as revenue. So the correct answer is C. All the revenue will occur in October when the sale takes place. Perry's Coffee Shop served meals in October. Customers paid cash at $1,200 for some of the meals, and then another $800 of meals were served in which customers paid with credit cards. So all of that is revenue in October. $1,200 plus $800, $2,000. Whether they're cash or credit, we treat them the same. That's all October revenue. I don't care when they were collected. Some was collected that month, some the next month, doesn't matter. All the revenue in October, 0 in September or November, so the correct answer is A. Now here we have cash coming in September, October for books that were actually sold on account or on credit in August. So all the revenue should have been recognized in August. We just have cash coming in September, October. So in August, the company recognized revenue and they would have shown an accounts receivable for the $750. And then in September, when they receive 500, cash will go up and accounts receivable will go down. No revenue to recognize in September or October because all that revenue was recognized in August when the sale took place, when the books were delivered, when the earnings process is complete. So here Perry decides to earn a little extra rent revenue by renting out office space for $700 a month. They get a check for 3 months in advance on October 1st, $2,100. So this is kind of like a down payment we just saw earlier. So Perry's cash would go up $2,100 and they'd have a unearned revenue, a liability for $2,100 that they will earn as the months pass, October, November, and December. So each month, all they can recognize is 1 month's worth of revenue. So at the beginning of October 1st, they would actually have a liability of $2,100. Then at the end of October, we would take 1 month of revenue out of the unearned liability. We would reduce unearned liability by $700 and show $700 as revenue for October. And then we do that in November and December. So the correct answer is D, no revenue in September, but $700 of revenue in October and $700 in November.